Hello and welcome to this month's CHATS segment of the Financial Perspectives podcast. Our CHATS episodes feature dynamic conversations between industry experts from some of our recent and most popular webinar recordings. This month, you'll hear from Victor Haghani and Ken Fryer as they discuss financial strategies for sustaining wealth over time.
Good afternoon, everyone. Thank you for tuning in today. I'm Ken Fryer. I'm a member of the CFA Society of San Francisco and also part of the Member Programming Advisory Council. It's my pleasure today to welcome you to How to Not Lose a Fortune, a fireside chat with Victor Haghani, who has just published this terrific book called The Missing Billionaires. If you're on this call, chances are, well, it's almost certain that you are responsible for the long-term outcome of a pool of assets. Certainly, you'll be responsible for your own retirement savings. And many of us on the call are also entrusted by other people to manage long-term assets for them. We are just really privileged today to have with us someone that has the answers to the two most important questions. How should I invest my money? And how much can I spend? And before I launch into the chat with Victor, I want to note that for the first part of this discussion, you'll be muted, but we do have a Q&A box that we'll be monitoring. So if you have a question that comes up along the way, please do enter it as a Q&A using the Q&A function. This event is also going to be recorded, and we'll be sharing the replay. So now it's my pleasure to introduce Victor Haghani. One of the terrific things about investments as a profession is you can just keep getting better. you get battle scars. You have a lot of different market cycle, a lot of different experiences. Victor's been on Wall Street. He's been at a high-flying hedge fund. He's been in wealth management, and what he's done with along with his business partner James White is he's kind of synthesized a lifetime of experience and the research to answer those two big questions. How should you invest and how much can you spend? The premise of the title of the book, The Missing Billionaires, is that if you look at the statistics about millionaires of the Gilded Age, there are enough of them to, if following proper investment and spending strategies, to have generated thousands of billionaires today. But if you look at the Forbes tables, you will not find many whose wealth dates back to the Gilded Age. In fact, most of the fortunes are relatively recent. This book hits rather close to home to me because my great-grandfather was one of those millionaires of 1900. He had yachts and mansions in New York and in Connecticut. And all I've got now, I've got a table behind me. I've got a painting, but didn't end up with much from that. So, Victor, let's start with how you set up the book. It turns out in practice to be terrifically difficult to maintain wealth across generations. Why do you think that is, and what do you think are the most important things that families do wrong?
Thanks, Ken. It's great to be on with you, and I've really enjoyed our few conversations that we've had leading up to this as well. It's interesting, talking about your family background. For me also, my family background is not, it's not quite, I think, as dramatic as your case in terms of so far back and the yachts and all of that. But just thinking about my own grandfather on my mother's side. He was in the furniture business in upstate New York, and he had done very well in that furniture business by the early 1950s. And I had calculated, and he was very interested in investing in the stock market. And my mom really picked up that from him, and maybe she passed it on to me as well as from my dad. This love of markets and numbers and everything. But just thinking about where my grandfather was, in about 1950, that he was involved in the stock market all through the next almost 60 years until he passed away at the age of 99. And, it's really remarkable, sort of how much that wealth underperformed the growth in our in our U.S. stock market, in our broad U.S. stock market, in our broad U.S. economy and per capita income, et cetera. And but anyway, that's nothing. And by the way, my grandfather, I don't know why I'm even bringing up my grandfather, because my own experience of being in Wall Street in a fabulously valuable seat in the 1980s, I certainly made a mess of things myself. But that's another story, and that's chapter 8 in the book. But I think that in answering the question of what do we think people got wrong, because we don't know. It's really that we can see this. There's no doubt that we're missing a lot of billionaires from 1900, but we don't know exactly what happened. We can only read the story of a few of them, and even when you read those stories of Vanderbilts or Astors, it's hard to tell exactly what happened. But our belief is some of the things that we don't think happened, or we don't think that presented insurmountable barriers, were the investment environment was phenomenally good in the U.S. from 1900. $1 in 1900 invested in the stock market with no taxes and reinvesting dividends became $100,000. Every time I say that, it just doesn't seem right, but it became $100,000.
Potential for all these billionaires that didn't happen.
Yeah, it's incredible. Well, it was a 10% nominal return for 120 years. And so the investment environment wasn't the problem. Taxes, taxes could be a problem, but I don't think that they really should have been, because, there is the ability to defer capital gains. You pay capital gains on what you would spend, let's say, but many families would have set up dynasty trusts so there wouldn't really be inheritance tax coming on down. Philanthropy certainly was something that some people practiced heavily, but not all of them. So that doesn't really, account for all of them being missing. And they had advisors. They had all kinds. These families would have had all kinds of advisors. So I think that sure, some of them really spent in a profligate manner, but I would say that most of them at least started off spending in a pretty reasonable and sensible manner. So, even when the Vanderbilts were building these mansions in New York City, it probably looked kind of reasonable to them, because they would buy something, buy a New York City block and build a beautiful house, a huge house for like maybe it cost them $3 million, I've read in some of the books. But, they had $40-50 million. So it isn't that crazy by today's standard. If somebody had $40 million and spent $3 or $4 million on a house, we wouldn't say that person was extravagant at all. So what our belief is, and really the central theme of our book is that they had too much uncompensated risk in their portfolios. They had the wrong sizing decisions in terms of their investments, and that they followed spending policies that over time were unsustainable. So I think that the whatever people were doing looked pretty rational to short horizons, but over very long horizons, they were very very dangerous to the sustainability of their wealth.
All right, so it's primarily concentration of risk in the portfolio, like undiversified portfolio, and it's the spending relative to the assets, right? So let's move to that. The spending relative to the assets. Most of us on the call are probably familiar with the 4% rule, the famous advice that when you retire, you could spend 4% of your savings at that point, and then you can raise the amount you spend each year with inflation as time goes on. That's sort of well accepted. I saw Morningstar just this month or last month came out to say, well, now that interest rates are higher, you can follow the 4% rule again. In your book indicates that that's a far from optimum strategy. I think the audience would be really interested in understanding why.
Sure. So I think that actually just trying to illustrate something, trying to illustrate something with a little toy example is a good way of addressing this. So and really, I think that the main point here that we try to talk about in the book, and that goes back to the early work on this area called lifetime consumption and portfolio choice, which was kind of started off to a large extent by Paul Samuelson and Bob Merton at MIT. But I think there was also some starts of that before they really dug into it. But they really kind of made, and Bob in particular, really made the breakthroughs in this, and showing that, in this intertemporal framework, in somebody's lifetime, that spending and investing are just connected in a way where it just doesn't make sense to take risk in your investment portfolio, but to have your spending be completely unresponsive to changes in your wealth or changes in expected returns. So let's just take a really simple kind of toy example of, imagine that let's just say that imagine that you're going to make an average 5% return above inflation on your portfolio for the next 25 years. So that for sure. The only thing is that you got a lot of risk in there, but you're going to, I'm guaranteeing you that you'll make 5% on average, taking each year's return and averaging it together, the arithmetic return, call it, over the next 25 years above inflation. And then you go and follow this, the rule that you explained there, this 4% rule where you're going to spend. So let's say you're going to start off spending 4% of your wealth to begin with, and then adjust that for inflation going out. But it's a fixed number, just adjusted for inflation. It's not 4% of what your portfolio is each year. It's 4% of your portfolio at retirement. So let's say, I don't know, you have $1 million, and so you're going to spend $40,000 and adjust that for inflation. But this portfolio that you have has got this 5% average return, but is moving around by 30%, has a 30% annual risk, which is a lot of risk. And, the way that you would get to something like that is to have a very concentrated portfolio, maybe in tech stocks, for instance, or, a certain sector that you really felt that you understood. Maybe it's a sector you worked in, or maybe it's your own business, whatever it might be. It is plausible, it's high, but it's very plausible to have 30% annual risk. So 1 year your portfolio goes up by 35%, the next year it goes down by 25%. And so over 2 years, the average is 5% a year. And so the question that we ask in this example is, after 25 years, what's the most likely amount of wealth that you would have left if you followed that policy with that portfolio? And it kind of seems like, well, I'm spending 4% or $40,000. That's less than the 5% real return that I'm guaranteed on my portfolio. So it seems like things might be okay. But in fact, the answer, surprisingly, is that your median wealth after 25 years is zero. And the reason for that, I think it is a pretty surprising result, and it's kind of fun to just put it into a spreadsheet and see what it looks like. But what's happening is that, let's think about what your compound return is. So if you had $1 million and then you went up by 35% the first year and then down 25% after the second year, after 2 years, you would only have made $1,000. You would have $1,001,000. In other words, you would have made a 1% return over 2 years, or a 0.5% return per annum. So your compound return is just getting killed by that volatility that you're having. So your average arithmetic return is 5%, but your compound return is all the way down at almost zero. And so now when you're spending that $40,000, you can see that you're just, if your compound return is 0.5% a year and you're spending 4%, then, or $40,000, I should say, you start going down, and then it really starts to accelerate after say 10 years or so. So you're sort of going down slowly. But then when your wealth has gone down to, say, $500,000, then you're just falling off a cliff really quickly, because that 0.5%, now you're starting to be spending effectively 10%, getting close to 10% of your wealth. So, I think thinking through that example, it just kind of shows us how, over the short term, you don't see too much happening, and that volatility is actually, you're not going up 35, down 25, all kinds of things are happening, and you might not be noticing what's going on. And one other really pernicious thing that's happening in there, and maybe we can talk about that later, right, is that when you're making that making a real return above inflation is not quite the same as how your spending is really, how you really want your spending to grow, because over longer periods of time, if your spending just kept up with CPI inflation, you kind of feel like you're falling behind, societal wealth altogether. But we'll talk about that more. I don't want these answers to get too long.
So the key takeaway, I think, to summarize for the audience is that if you have a spending rule that starts with a fixed amount and then continues to grow the spend, regardless of what's actually happening with your assets under management, it can be dangerous if you have a high volatility portfolio, because you could crash out. Let's say that your early years are bad years and you have lose half your assets, but you're still spending 4% plus of your original assets, which is now maybe too much, kind of overwhelms the investment return you get from a lower asset base. And so you can run out of money in a generation. And you're saying that on average, that's what would happen, is you run out of money in a generation. And it's much, much more important to have your spend flex with your assets than to have some kind of rigid. Is that?
Well, there's two problems going on there. That's one. I think that's the bigger problem that you just elaborated in practice. Yeah. But almost an equally big problem is having a spending level that even if you were following a 4% spending rule, spending 4% of your portfolio each year, you still would be going down because your compound return is only 0.5%. So you'd be, that in terms of just your median wealth. Now, your expected wealth is doing something else, because there are these cases where you're like growing out of it. But if you're in that median sort of case, you're in a lot of trouble because your compound return is so low and you're spending that 4%, even if it's variable, you're still getting hurt. But when you put those two things together, spending too much and spending in a fixed manner, and you put those together, it's just catastrophic. I mean, to run out of money after 25 years where you think that you're in this where you have a sustainable approach is really disturbing.
So one of the central topics in your book is if in a world where there's a risky asset, let's say stocks, and a risk-free asset, let's say tips, then one has to make a choice about like how much to have in risky asset versus the non-risky asset. And there's a formula for that that's very dependent upon the volatility of the risky asset. And probably for my clients, probably for your clients, for a lot of the people on this call and the people on this call know, they have concentrated portfolios. People here in San Francisco, they tend to make their money from having stock options in the company that they work for. And so let's take an example of, let's say one of our listeners works at Tesla, and Tesla stock's done very well. This person now has more than half of their net worth in Tesla common stock. The annual volatility of Tesla stock is 50%, so it's very volatile stock. How would that person make a determination about whether they have too much? Like, how do you determine what's the right amount and what's too much for a concentrated position like that?
Well, Ken, I think right at the beginning there, you were alluding to this really simple formula that we call the Merton share, which says that your optimal holding in a two asset world where one is safe and one is risky, that the optimal amount to have in the risky asset of your portfolio is equal to the expected excess return divided by the variance of that asset. In other words, the risk of the asset squared. So in your case, it's that 0.5 or 50% squared, which is 25%. And then also divided by your indexed or coefficient of risk aversion, which tends to be in the 2 to 3 range for most wealthy, sophisticated clients that we talk to. Now, that happens to be related to another betting formula called the Kelly criterion that probably lots of people have heard about. It's more of a way to maximize the growth of your bankroll if you're playing blackjack and counting cards or playing poker. And that's related to the Merton share. It just is one particular coefficient or one parameterization of the Merton share where that coefficient equals 1. So sort of thinking about that question of Tesla, the first thing I'd say is, well, the really you've come up with the standard deviation of 50% a year. We would need to come up with the expected return of Tesla. And, at this point, we hope that markets are, Tesla is big. It's part of the S&P 500. Everybody knows about it, et cetera. It's had tremendous returns. But looking forward, I think that, let's say that we thought it was going to have a 5% excess return above the safe asset, which would probably be higher than what U.S. equities in general are offering relative to the safe asset today. Well, at 5%, at a 5% excess return, we would be saying, well, you should probably have like less than 10% of your wealth in Tesla, assuming that the rest of it was just, assuming that your only two alternatives were a safe asset and Tesla. If you have also the opportunity to invest in the stock market, well, then that's going to want to be, since the stock market and Tesla will be correlated with each other, that would lead you to a lower amount of Tesla. Now, if we were more bullish and we also had a lower coefficient of risk aversion, we were more risk tolerant. I could see a case where somebody said, well, I think Tesla's just great. And I think it's going to make 10% above the risk-free rate, which I think would really be at the limits of anybody's belief about market efficiency. Thinking of a multi-year 10% expected return just seems really out there for me. But even if we took that, that would take you to like a 20% optimal exposure to Tesla stock, given that volatility, and assuming that you had nothing else that you could invest in other than safe assets. So, I think that, I guess I would say that under a reasonable set of assumptions, my answer to your question would be that such a person should be trying to get their holding of Tesla down probably below 10%, for something like that. Now, right at the beginning of what you were saying that this Merton share, this sizing is very sensitive to your volatility. I mean, it's very sensitive to your expected return, obviously, but it's really sensitive to your volatility belief or expectation or assumption, because we're squaring that, right? We're taking that 0.5 and we're squaring it in the denominator. And so, but at the same time, it's kind of easier. I think that I think it's much easier to think about the risk of a stock than the expected return of a stock in many ways. You can, that you're just getting all this information about the risk, like every day, how's it bouncing around? It's really hard to estimate expected return from anything, but risk is a little bit easier to come to. We also have options markets that are giving us expectations. We don't really have any markets and expected returns that we can really look to.
Well, let's make sure that I understand this right and the audience understands it right, because this is one of the profound things that I took away from the book. If Tesla stock is has a vol of 50%, and let's say the S&P 500 has a vol of 16, so Tesla has triple the volatility of the S&P 500, then wouldn't it be the case that an individual who was comfortable with a 90-10 S&P 500 and fixed income portfolio would be comfortable with a 10-90 Tesla fixed income portfolio if they felt the excess return was the same of Tesla versus S&P? Did I state that correctly?
Yeah, I think that's right. That in other words, that you would want to have 1/9. That if the volatility is 3 times as big, you would want to have 1/9 the position for that same
or in other words,
return.
If you thought the S&P 500 was going to return 5% over the risk-free rate, you'd need a Tesla to return 45% over to be equally comfortable. Is that right?
I think that's right. Yeah.
Yeah. Yep. Okay.
Yeah,
so that was it. I mean, this is, I think, an important takeaway for people in the Bay Area is just how much better the return has to be for a very risky holding in your portfolio for it to be optimal for you to have it. So, all right. So I hope we made that point. And
sorry, but Ken, I just want to say that's what it would take to get you to have the same holding. But but if Tesla had 9 times the return, it would have a much better Sharpe ratio, and so you'd be you would be much happier. You'd have
okay.
You know what I mean? You'd be much happier.
Risk aversion enters into this.
Your welfare, your expected utility, expected welfare, your certainty equivalent wealth, you'd be much happier because wow, this Tesla has this really high Sharpe ratio, and despite its risk, I want to have, you're just wealthier in that case, but you would have the same holding of, that's what it would take for you to have the same holding of, whatever, 90% in the S&P 500 or 90% in Tesla. You would need 9 times the return if you had 3 times the risk.
Great. So Billionaires book has all the math and the reasons behind the math for optimal asset allocation. And it won't surprise the audience to know that the optimal asset allocation is a function in part of the expected return of the assets on the menu and the risk of the assets on the menu. A point you make in the book is that expected returns change and risks change, and therefore your optimal asset allocation should change as market conditions change. And yet, if we observe investment practice across the board, institutional funds and private wealth funds, people don't tend to like to make changes in their portfolio. So can you address that, both why a more dynamic adaptation to market changes is better, and B, sort of why it's not really broadly accepted among investment professionals, and what would it take for it to be better accepted?
Okay. Well, I think that in terms of why it's better, I think that I can't improve on what you said. I mean, I think the way that you said it kind of makes it self-evident. I think, that if you believe that things are changing, and if you believe that you can, see how they're changing, you can see that interest rates, that real rates have gone up or down, or that the earnings yield of equities is changing and the riskiness is changing.
Like 10-year Treasury bond at 5% is a different deal than 10-year Treasury at 0.5%, which is what it was.
So once you I mean, it would be one thing to say that everything's changing, but we have no idea how it's changing. Which would be a weird sort of thing to say. But anyway, I think that you've done a really good job, and I want to be respectful of our time too. But of doing a really good job of why it makes sense. Why is it not more practiced? I think there's a couple reasons. One, I think that that one reason is that this market timing, that somehow there's been like a conflation of stock picking and market timing, where both of them feel like they are activities that rely on beating the market, and that they're zero sum, and that in efficient markets that both of them are fool's errands. And I think that but I just don't think that's at all the case. That stock picking is a zero sum game largely, but changing your asset allocation is not. I mean, you're doing what's right for you at each moment in time, and I think that it is possible for all of that to be consistent with efficient markets and macro efficiency. I think the other reason that it hasn't been that popular is because over the last 50 or 60 years, that the simplest kind of approach to implementing that hasn't fared very well, because U.S. equities in particular have just been trading at higher and higher multiples over a long period of time. So, there have been these times when it looked like equities were offering very little excess return relative to safe assets, but then, lo and behold, they did very well, even beyond that. And so it's kind of like, you're betting, that you're betting on a 60-40 coin, and then they say, okay, now the coin just has a 55% chance of heads. And you say, okay, I better reduce my bet size because that's less attractive. But then we just keep getting, lots of heads. We get 60, that in the next 10 flips, we get 6 heads, and it's like, oh, well, I wish I had kept betting more on heads. I would have made more money. So, it's a really good question, but, I think those are some of the reasons. And I think that, people that this, there's also just so many people have practiced market timing in a very subjective, non-systematic manner. And then that becomes really tough. If you're just trying to guess where the market is going, in the next 3 months, that's an impossible task. And, if you make massive changes in your portfolio to try to take account of that, then that's a problem.
All right. Well, we got a tough question from an audience member. And before I pose this, let me encourage others who are listening to enter questions using the Q&A box that you'll find at the bottom of the screen if you're using this Zoom. So this is a tough one, maybe. It says, can you please explain how your portfolio choices are different for taxable versus tax-exempt investors? Like, how does the optimum change given, it says, given the implicit risk-sharing arrangement with the government? But in general, if you're a taxable investor and the families, that we're talking about initially would typically be, taxpayers, how does that change the optimum?
Sure. So, everything is so much easier in the absence of taxes. Mm-hmm. We devote a chapter of the book to thinking about how do taxes change things for investors. And I guess that what it looks like in general is that to a very, very long horizon, that capital gains taxes tend to, that our overall tax regime of long-term capital gains taxes being asymmetrically applied, but being lower than taxes on ordinary income and short-term gains, winds up leading to a long-term allocation, optimal allocation to equities, a tiny bit higher than you would get if you lived in a no-tax world. But it does depend on your assumptions.
More equities if you pay taxes than if you didn't.
To a very long horizon, to a very short.
Because you need a higher return. Is it because the tax is going to erode your return, and you need more equities to build your wealth? Is that the reason?
Well, I think there's a couple of things. No, it's not so much that. There's a couple of things going on. One is just that that when you put taxes in there, and now your safe asset is getting taxed at a higher rate, and currently, whereas equities are benefiting from deferral and a lower tax rate, but they're also kind of being hurt by this asymmetric sharing with the government, where you'd have all the losses, but the government takes part of your gains. But when the horizon gets really long, those first two effects are outweighing that third effect and leading you to want just a little bit more equities. Again, we talk about that in some detail in the book. It's a complicated question. To a very short-term horizon, equities start to look really bad if you can't use a potential tax loss. So if you put a zero value onto a tax loss because you have the short horizon, now you've just that option, the option that effectively the IRS has on us or the Treasury has on us, really makes you want to have a lot less equities. We also go through some examples of what if you have a portfolio of very appreciated equities with a very low basis. How should you think about realizing gains? If your ideal portfolio would have been to have less equities, but you now have a lot of equities because they've gone up so much, and you haven't realized anything, and you've been spending out of your safe assets. So your asset allocation is way skewed towards the risky asset because you don't want to pay taxes. Does that make sense? How do you balance out trying to get to a more sensible portfolio for you versus paying tax now rather than later? And that's a risk-return trade-off that we go through in that same chapter. But really, both really complicate pretty well. I don't know. I mean, they're less complicated to me now that I've been thinking about them for a long time. But I think they are kind of tough questions.
Okay, so it makes a difference the possibility of long-term capital gains treatment for equities versus the fact that for bonds the coupon income is taxed presently, at least by the federal government if it's treasuries.
Yep.
All right. So then you know more than probably most people as to what an optimal investment portfolio looks like. And you, like me, as someone in wealth management who encounters people who bring portfolios to you, what would stand out as the number one thing that you want to change, or that you think is the number one flaw in many of the investment portfolios that other people manage that you see?
Well, I think that kind of the most surprising thing to me is that so few wealthy people have portfolios that Harry Markowitz would have said, oh, okay, I'm glad people have taken on board this idea of the market portfolio and going for maximum diversification. That so many wealthy families and individuals seem drawn to the pursuit of alpha through concentration, leverage, special managers, magic, and so, we just often see portfolios that are very complex, that seem to us to be extremely tax inefficient, that seem really labor intensive, in terms of, just dealing with the, subscriptions, redemptions, all these different things, that we just don't see simpler, highly diversified portfolios very often at all. Although, of course, people talking, there's a selection bias there. I think that we just, that for people that really are doing, really sensible sort of textbooky kind of investing, we don't hear from them much. They sort of are just happily doing it, and they don't need much help, and they've sort of got it, and they've got it going. And we wind up talking to people that are looking for help. But that is kind of what we see, is just so far from the market portfolios. So in U.S. investors, such little international diversification. It's remarkable. We're a great country here, but we are 5% or less of the world's population, et cetera. The
overly complex, not diversified enough portfolios. Is that?
I think so. Yes.
Mm-hmm.
I think, effectively bearing some extra risk that I don't think really gets compensated.
And does that relate to, a lot of family offices are, interested in the potential of alternative investments, private equity, private credit, private real estate, hedge funds, et cetera. What's your stand on sort of the alternatives part of the portfolio and its value added?
It's kind of, to me, it's there's two problems, where that there's a joke about this guy walks into a Rolls-Royce dealer, and the salesman comes over to him and says, "Are you interested in buying one, sir?" And he says, "Well, I am, I just have two issues." And he says, "What are your issues, sir?" And he says, "Well, the first one is I can't afford it." And the salesman says, "Okay, you don't need to tell me the second one." So in this case, for me anyway, I just think that the general tax inefficiency of alternative investments is kind of enough for me as a taxable investor, to just say, I just don't want to buy. It can't make sense to me to pay those fees, to have this tax inefficiency, that it's just not plausible to me that there's any return left over. And I know that there's this huge pool of capital that's non-taxable that is investing in this stuff and is kind of setting the price. So as a taxable investor, it's kind of easy. It's sort of an easy one for me, I think. Anyway, for me, it's been an easy one. I do think that, ultimately the only way to make alpha is through concentration and leverage, there's no other way. You can't be done without those, some combination of those two things.
For alternative managers to do well is to concentrate and use leverage.
Yes. And so, there's also this risk return thing for me where I feel like, okay, I also just am really not convinced that there are many alternative investments that are alternative in terms of what I care about in terms of risk, where, I just don't want to lose all of my money in a massive economic and financial meltdown, as we saw to some degree. We didn't see the full extent of it in 08, in 07, 08, 09. If that had gone on for another 6 or 7 months, we would have really had something to remember, in terms of just how much damage could have been caused, by a really out of control meltdown. And, I think that these alternative investments they look pretty alternative in normal times, but when the crisis gets big enough, it sort of sweeps away everything that is not everything, but most everything that's alternative will tend to get swept away in a big enough financial crisis. Not everything, I think there are some strategies that can do well in those environments too, but in general, most of it I think goes down the tube, along with equities. But at least with equities, we kind of know what we're getting. We have them on an unleveraged basis, et cetera.
Right. It's so better to have a sort of liquid, transparent, diversified portfolio of the betas that are optimal for you, right, then add this complexity or tax cost.
That's what I think. Yes.
Okay. So one other thing that you probably see investors do is they love to search for managers, for active managers in particular. And you are working on a paper on the, I'm going to mess this up, I think, the risk hypothesis. In any event, the point, what I'm going to ask you about is that for an active manager in a liquid market, like let's say a equity mutual fund, the odds are already against the manager, because if they charge high fees, then it's hard to get a net of fee result that's better than the relevant benchmark index. But your paper that you're about to publish indicates that it gets even worse when you start looking on a risk-adjusted return basis for active funds.
I think that's right. I mean, we just wrote a paper that's coming out today where we restate the famous Sharpe's arithmetic of active management, which got picked up by John Bogle as well in his cost matters hypothesis, that says that all active managers, all non-market cap weighted portfolios added together equals the market portfolio. Will have the market return less whatever extra fees there are there. And that's powerful. That he wrote that in 1991, and it probably has a lot to do with the intuition that people have regarding why owning market cap weighted big index funds is a good thing to do. And we point out that that Sharpe even could have gone further if he wanted to at the time. It seems like maybe he just felt like that was a strong enough argument then, and it was really powerful. But he could have even gone a step further and pointed out that the same logic that he was applying in terms of all active portfolios aggregate together to the market portfolio, to point out that the average risk across all active portfolios is higher than the risk of the market portfolio. And so, investors in aggregate who are holding active portfolios of stocks need in aggregate to earn a higher return to compensate for that higher risk. And just as with Sharpe's arithmetic or Bogle's cost matters hypothesis, it's not possible. Not everybody can do that. So, we're all kind of, that in aggregate, we're facing, one threshold, which is the higher fees of active management, and then another threshold, which is the higher risk of active management. And the size of those, thresholds or hurdles, the height of those hurdles in aggregate for all of us are similar to each other. They're both really quite high, in aggregate. And we're calling that the risk matters hypothesis, kind of as an homage to John Bogle and his cost matters hypothesis that he stated so strongly.
As we said earlier, if the amount of excess return that you require is proportional to the square of the risk, if your active manager is even a bit more risky, that person, they better generate a fair amount of extra return for that additional risk.
Yep.
Right?
Yes.
We got a really interesting question here. I'm going to throw that in. I know we're short on time, but it's about sort of when to transition. Like most of our clients, and I bet most of your clients ended up wealthy by having a non-diversified exposure to an investment, such as our Tesla employee. Right, they get wealthy that way by owning Tesla stock options. But when do you need to transition? Right, if you want your money to last, and you need to make that switch from your concentrated portfolio that got you to a level of affluence to a more diversified portfolio. Do you have a sense as to like when that should happen? When is it too late?
Well, I think there's like two things going on there a little bit. The first one is that somebody could have somebody's got their business and they've got this visibility into the business, and they just are certain that they're going to do a double triple on revenues in the next 4 years, and they can see it, and nobody else can really see it. So somebody comes to them is like, "Oh, I love your business," and they want to buy it, and you just say, "I can't sell it to you at this price because you don't see. I can't show you the double triple that's coming."
Right.
So there's that that happens sometimes, but in general, I would say that that it's like it's never too early. I think that that it's never too early, and the way that our system works for entrepreneurs, is that our entrepreneurs get forced really far down the road before they have an opportunity to take some money off the table. And I would say that as soon as, that in general, as soon as you do have that opportunity, without really being a detriment to your business and everything else, that, it's going to make sense to do that. So, my son, for instance, is my eldest son has a small startup business that he's got going he is trying to help trade and technical schools with their payments and processing. The one thing I try to talk to him, there's nothing much for him to do, but I think that, he doesn't have a choice. He can't take money off the table now. But I think that when he has a chance to take some money off the table and to get a win, something of a win and some financial independence for himself, that he's going to do that, even if he's pretty bullish on the business, just knowing how risky, each individual, especially small business is. So, I would say the optimal time is just as soon as possible. I think applying,
right.
The cost of risk or expected utility to these situations makes sense. Now we have to take account of our human capital and all that, right? It's not all about financial capital, but I don't think, I think that sort of letting it ride to get really rich. It's almost like, anybody that's made $10 billion probably was doing something pretty suboptimal along the way.
Yeah. All right. So do it when you can. Sometimes you'll have constraints if you're in charge of, let's say you're the chief technology officer for Tesla, and so you're reporting your stock transactions. You probably can't sell a lot without notice. So do it when you can. But I think what comes through in your book is just how important the managing risk, having diversified portfolios, sort of trying to achieve your return at the lowest available risk to get that return is. I think we're going to wrap up here. I really want to endorse this book. These shelves here are heaving with investment books, and what I think Victor and James White have done is just synthesize, their lifetime of experience and also the empirical research and the industry research to have some sort of interesting perspectives on, how we can do a better job of deciding how to allocate and how much risk to take. So with that, I think I'd like to thank all of you who have joined us today, and especially like to thank Victor for your time and your comments and for producing this terrific book, which I'm sure.
Oh, thank you. Yeah, thank you so much, Ken.
I mentioned it just won an award. The Economist magazine just put out its list of the best books of 2023, and that book is on it.
Oh, so thank you.
Thank you, Victor, for joining us today, and thanks for those of you who participated in the call.
Thank you for listening to this month's CHATS segment. CHATS is a monthly segment featuring audio from our recently recorded webinars, airing on the second Tuesday of the month. To view the video recording of this episode and discover additional Society webinars, visit the CFA Society San Francisco YouTube channel. Join us next time for our regularly scheduled Financial Perspectives podcast episode, airing on the last Tuesday of the month. And make sure to send in a message to the show using a link at the top of each episode description, or by emailing podcast@cfa-sf.org. We'd love to hear what you think of our new chat segment or any suggestions on future topics you'd like us to cover. Thank you for being a dedicated listener. This podcast is produced by CFA Society San Francisco, a not-for-profit professional association providing professional learning and career resources to over 13,000 investment industry professionals worldwide. To learn more about CFA Society San Francisco, visit our website at cfa-sf.org or connect with us on LinkedIn.